Hello and welcome to this special segment of Money Control Pro's Stock of the Day. I'm your host Stacey Pereira, and today I'm going to be talking about a company that has often helped us get rid of our body pains and headaches. Yes, the makers of Zandu Balm, Navratna Tel, Fair and Handsome, Brooplus. I'm talking about the Emami Group. It is an FMCG company that has engaged in manufacturing as well as marketing of personal care as well as healthcare products. It is present across India, the Middle East, North Africa, the CIS region as well as SAARC countries. Now, its acquisition-led strategy is what has helped it expand into various categories. But why do we like Emami? It is because it has some pretty strong brands across its portfolios. It saw 2% volume growth in the March quarter. In fact, Dermicool and Helios Lifestyle contributed to 10% of its revenues in this quarter. And excluding the sales of healthcare and pain management that saw quite an upswing in consumption during COVID, domestic sales have grown at 11% for the March quarter of 2023. Now, Emami has also gone ahead and launched around 20 new products in FY23, with majority of them being digital-first launches. Another factor that could work for Emami is the recovery being witnessed in rural markets. It derives nearly 50% of its revenues from rural India and added 31,000 chemists in FY23, taking the total to 1.30 lakhs. It also currently reaches 52,000 towns and villages and plans to add another 8,000 by FY24. Its products are now available in over 5 million retail outlets across India with its distribution network of 2,800. And it's not just its increased distribution reach, the company has also introduced lower price point packs in order to bring in new consumers into the fold. Softening raw material prices is another reason that could favor the company. The March quarter saw its gross as well as EBITDA margins recover on a year-on-year basis, and price increases in select portfolios as well as softening of raw material prices has also aided its recovery. And the company's management has also given a positive guidance for FY24, where they see domestic sales growth of 8 to 10% in FY24. They say that if raw material prices declines further, EBITDA could be at 27% in FY24 compared to the 25.3% in FY23. It is also looking at increasing its media investments, targeting a 16 to 17% of its revenues as compared to the 16.5% in FY22. Let's also take a quick look at the company's valuations. The stock is trading at a price to earning of 23 times FY25 projected earnings, and the valuation is reasonable as well as lower than the 3 and 5-year average of 39 times as well as 44 times respectively. So what are the factors that you should be watching out for? Like most FMCG players, seasonality impacts the categories for Emami as well. Also, the fact that most of its products are considered as discretionary spends could have a bearing. Well, that was a deep dive into Emami, but for more such detailed stock analysis, keep tuning in to moneycontrol.com because we'll be back with a lot more.